Hi there. When you inherit property in the UK, the probate value often becomes your capital gains tax base cost. In this video, PTA explains the rule many heirs misunderstand.
Hello and welcome. Today, with the help of the expert tax advisors at My Tax Accountant, we're going to tackle a financial trap that catches countless UK families completely by surprise. We're going to look at a really crucial question. When is the value of an inherited asset actually set in stone for tax, and when is it, well, a ticking time bomb? Let's get straight into it.
Right, let's paint a picture. You've navigated the whole difficult process of probate, the family home has finally been sold, and you think, okay, that's it, it's all done. You breathe a massive sigh of relief. But then, months, maybe even years down the line, a brown envelope from HMRC drops on your doormat. Inside is a huge, totally unexpected tax demand. Believe me, this isn't just a nightmare scenario, it happens all the time, and it all boils down to a massive misunderstanding of how inherited assets are valued for tax. So, what is this hidden trap I'm talking about? Well, it's the dangerous gap between the value you put down for an asset during probate and the value that HMRC's capital gains tax department will accept when that asset is sold, often years later. You see, most of us just assume those two figures are one and the same, but here's the kicker. When they're not, the financial hit can be absolutely staggering. It's almost like having two different referees for the same game, but they're using different rulebooks, years apart.
Now, before we get into the nitty-gritty of the trap, let's start with a really important and actually quite generous rule in the UK tax system. When a person passes away, any capital gains tax on the growth of their assets during their lifetime is completely wiped out. This is often called the CGT uplift on death. It essentially hits a big reset button, wiping the slate clean for tax purposes from that day forward. And this shows you exactly how that reset works. Let's say your parent bought a house ages ago for £50,000. By the time they passed away, it was worth £250,000. That entire £200,000 growth, for capital gains tax purposes, it's just gone. It vanishes. The new starting point for the beneficiaries, the official base cost, is now that £250,000. Any tax will only be due on growth above that mark. Now, on the surface, that's brilliant news, but it leads to the single most important question. Who gets the final say that the value was really £250,000?
And that brings us right to the heart of it. The key to whether that probate valuation is locked in, whether it's truly set in stone, all hangs on one very specific word that HMRC loves to use: ascertained. Seriously, understanding this one word is the difference between tax certainty and a massive future headache. Stay with me, this next part is absolutely crucial.
So, what on earth does ascertained actually mean to the taxman? It's not just a number you've written on a form. For a value to be officially ascertained, two very specific things have to happen. First, HMRC's inheritance tax team has to have actively used that figure to work out a final tax bill. And second, the amount of tax that was paid had to directly depend on that specific valuation. If no tax was paid, or if the value didn't actually change the final bill, then guess what? It has not been ascertained. Here's the trap in action. We all think of the probate value as the official figure, right? It's a number we put on a form, maybe from a quick valuation. But the reality is, HMRC might never even look at it properly. An ascertained value, on the other hand, is a figure that's been through the fire. It's been scrutinized, maybe even negotiated, and then actually used to charge tax. Only that ascertained value becomes the legally locked-in base cost for any future capital gains tax. This simple difference catches so many people out.
So when does a valuation just get nodded through by HMRC, leaving you exposed to a challenge down the road? Well, it happens way more often than you'd think, especially in estates that seem pretty straightforward and don't end up paying any inheritance tax. You'll definitely want to hear this part. Let's break this down with some common examples. Imagine an estate where everything passes from a husband to his wife. Because of the spousal exemption, there's no inheritance tax to pay. So why would HMRC spend time and money checking if the house valuation is spot on? They wouldn't. The value is not ascertained. Or what about a smaller estate, say worth £250,000, well under the tax-free limit? Again, no tax is due, so HMRC has zero incentive to investigate. The exact same thing applies to a family business that gets 100% relief. In all of these very common situations, the tax bill is zero, probate gets granted, but those all-important values are left unverified and totally open to challenge in the future.
And here's my tip, direct from the experts. The biggest danger zone by far is with these IHT-exempt estates. You have to remember,
The tax office simply isn't interested in arguing the toss about a valuation if it doesn't result in them getting a tax payment. They'll accept the forms to let probate go through, but that is not the same as them formally agreeing with your figures. They are just closing their file and moving on.
So what's the actual risk here? Well, think of HMRC as this huge organization with different departments. The inheritance tax team's job is to collect IHT when someone dies. If no tax is due, their work is done. But fast forward 5, maybe 10 years. When a beneficiary sells that asset, a totally different department wakes up, the capital gains tax team, and their goal is to maximize the tax collected on the gain. They have a direct financial reason to argue that the starting value from all those years ago, your probate value, was actually too high. They can claim the asset was worth less at the date of death, and a lower starting cost means a bigger taxable gain and a much bigger tax bill for the seller. And the worst part? The burden of proof will be on you to defend a valuation from a decade ago. Good luck with that.
Okay, so that's the problem, and it's a pretty scary one. But the good news is you are not powerless. There are very clear, practical steps you can take to protect the estate, lock that value in, and give the beneficiaries total peace of mind for the future. Let's make this simple.
Here are the 3 essential things you need to do. First, even if you think you don't need to for IHD, get a formal, professional valuation. For a property, I mean a proper, detailed report from a RICS registered valuer, not just a quick letter from an estate agent. You need a document that can stand up to scrutiny years later. Second, submit this formal valuation to HMRC along with all the probate forms. This puts your solid evidence on their official record right from the start. And third, and so many people miss this, make sure every single beneficiary gets a copy of this valuation report. They will absolutely need it for their own tax returns down the line.
Now, we've talked a lot about protecting the value for the beneficiaries, but what about the tax situation during the administration period itself, before anything is handed over? This is something executors often ask about. Well, it's really important to know that the estate itself gets its own capital gains tax allowance, and it's completely separate from anyone's personal allowance.
So for the 2025-26 tax year, that allowance for the estate is £3,000. This means if the executors sell something, maybe a portfolio of shares, and make a gain, the first £3,000 of that profit is completely tax-free. And what's more, this allowance is available for the tax year the person died in and for the following 2 tax years. That gives a potential £9,000 in tax-free gains if the administration takes a while.
And what if the estate's gains go over that £3,000 allowance? What tax rate does it pay? Well, for the 2025-26 tax year, it's actually very straightforward. The estate pays a flat rate of 24% on any gains above the allowance, and that single rate applies to gains from both residential property and other assets like shares. Nice and simple.
So the crucial point to take away from all this is that being proactive when you're doing the probate is the only real way to stop a hidden tax problem biting you later on. A little bit of extra effort at the start can save thousands of pounds and a whole lot of stress down the road. Let's just quickly recap the key points to remember.
Okay, first, death gives you a valuable tax reset, wiping the slate clean on capital gains. Second, that new higher value is only properly locked in if it becomes ascertained by HMRC for inheritance tax purposes. Third, and here's the trap, the values in most tax-free estates are not ascertained, leaving the door wide open for the CGT team to challenge them later. The solution is simple but vital. Get a professional valuation done at the time, submit it formally, and keep crystal clear records for everyone involved.
And that really leaves us with one final, vital question to ask yourself. If you are dealing with an estate now, or think you might be in the future, is the valuation you're planning to use a truly locked-in, defensible cost, or is it just a future tax problem waiting to land on a beneficiary's doormat?
Now, it's really important for me to state that the information we've covered today is for general guidance only. You absolutely should not rely on it for your personal financial decisions. Tax rules are incredibly complex, and as we all know, they can and do change.
For professional advice that is tailored to your specific situation, we strongly recommend you contact the experts. You can reach the team at My Tax Accountant on the phone at 0208-570-8531, or you can drop them an email at info@mytaxaccountant.co.uk.
And finally, if you found this guidance helpful, please do subscribe to the My Tax Accountant channel for more clear and practical tax content just like this. Thank you so much for your time.